Chapter 9, Part 1, Account for Current Liabilities and Contingent Liabilities. Now, what are the differences among known, estimated, and contingent liabilities? Well, first, a known liability, we know the amount and we know that it's due. So it would be if we bought some goods and we received a bill. Estimated liabilities. An estimated liability is defined as a known obligation of an unknown amount. A business will sometimes encounter a situation where it knows that a liability exists, but does not know exactly the amount of liability. In these situations, the amount of the liability must be estimated. And a good example of this would be warranty reserves or allowance for doubtfuls. We estimate we won't be collecting a portion of our receivables. And then the last we talk about is what's called a contingent liability. It is a unique liability, but the key here is that it arises because of a past event, but it is dependent about the outcome of a future event. In other words, whether a company has an obligation depends on the results of an event that has not yet incurred. A good example would be a lawsuit. Now, examples of current liabilities would be accounts payable, short-term notes payable, sales tax. These are all current liabilities and the current portion of a long-term debt. Now, sales tax is unique because sales tax is what we call a pass-through, i.e., it never appears on the income statement, only on the balance sheet when it's owed. So, retailers collect the sales tax from their customers in addition to the price of the item sold, and then periodically they send this to the state, usually monthly or quarterly, depends on the volume. It's a current liability because the retailer must pay the state in less than a year. So an example, we sold goods of $100,000 with 8% sales tax, and this is what we would journalize. You notice the sale is only $100,000, but we have now a liability called sales tax payable. When we pay the tax, we're going to reduce our liability and pay it out. Now, what about accrued liabilities? Well, here we've got interest, because interest, remember, interest is incurred over time. We have salaries and wages payable, payroll taxes, and income taxes. So if we had accrued income tax, it would look like this: income tax payable, income tax expense. Now, here's the thing about income tax is we know we have to pay it, but we estimate until year end because it's based on what we've earned. Unearned revenue, also called deferred revenue, arises when a business receives cash before providing services. The business has an obligation to provide goods or services in the future. Unearned revenues are classified as a current liability until they're earned. Notes payable. Notes payable is a debt obligation that is supported by a promissory note. So it's always a signed document. They are usually due to be repaid more. If they're due to be repaid more than 1 year, you would treat it as a long-term debt. If 1 year or less, it's classified as current. So let's look at an example. So on April 30th, you purchased equipment for $120,000 by issuing a 1-year 6% note. So if you notice, we don't book the interest because interest accrues over time. On December 31st, we have to accrue the interest because we owe it, and interest is incurred over time. So 8 months have gone by. So we're going to have interest expense, interest payable. And then when we actually pay the note, first, we're going to take the notes payable off the books. We're going to take the interest payable off the books. We're going to book the difference of the interest expense, and then we're going to book the cash. So the cash is always your last entry there. Now, what about the current portion? Now, long-term debt is often paid in installments. Any amount, whether principal if paid in installments or interest due within 1 year, is classified as current. Now, we also have estimated warranty and contingent liabilities. Now with warranties, the seller has an obligation to replace or correct a product that fails to perform as expected within a specified period. And that's to conform with the matching principle, we have to record it. So, for example, a dealer sells a car for $32,000 on December 1st on account, with a warranty for parts and labor for 12 months or 12,000 miles. The dealership experiences an average warranty cost of 3% of the selling price of each car, and there is a balance in the estimated warranty payable of $1,000. So that's, now, remember, it's a liability account. It has to have, its normal balance is a credit. Now, if this account had a debit balance, it means you're underestimating how much you're paying out in warranty. So, when we book the sale, we're going to book the accounts receivable, and then we're also going to book the warranty expense based on our estimate. Now, what if in the following year we paid out $300 in warranty claims? It would go against the estimated warranty payable and cash, assuming that we gave them cash. Could be salaries payable, it could be parts, it could be anything, but we're going to make it simple and call it cash. Now, the thing to remember is you'll be asked the question, what is the warranty expense? Remember, when you're setting up warranty reserve, the warranty expense is always the estimate. So it's going to be $960. So the balance in our account now is $1,660. Now last, we're going to cover contingent liabilities. A contingent liability represents a potential rather than an actual obligation. The outcome of the future rent will determine whether a company will incur an obligation. Now we have to accrue if it's probable and we can estimate it. And we have to disclose it if the loss is reasonably possible, which means we've got to put it in the footnotes. So another summary of, now here's another thing to remember. We do not accrue current, if we expect to, say we just won a lawsuit and we're going to get $1 million. We cannot accrue that, okay? We cannot accrue windfalls, can't do that. You can only accrue potential liabilities because we're conservative. So, potential obligation depends on a future event arising out of a past transaction. Normally we're talking about here are fines or litigation. So, if it's remote or unlikely, we take no action. If it's reasonable, possibly, then we want to disclose that it's possible we're going to have to pay something. And probable, more likely than not, usually that means we've already reached an agreement, we just haven't paid it. Then what you're going to have to do is disclose it, i.e. journalize it. So let's take a look at some examples so you get a feel for this. Okay, a customer fell in one of French's stores and is seeking $150,000 in damages. French's attorney believes that it is remote that the customer will win the lawsuit. Now, we would say no effect, but between you and me, I would be accruing legal fees because you probably spend more than $150,000 just in legal fees. So that's something you always have to consider. Second, another customer becomes fatally ill after eating some bad snails purchased from your restaurant. The customer wants $200,000. French's attorneys believe it is probable that the customer will win the lawsuit. This you have to journalize. However, again, more than likely, all you journalize would be the legal fees because you don't want the people to know you're going to pay them, unless you've already signed an agreement. A competitor is suing French for a trademark violation and is seeking $1.5 million. French's attorney believes that it's reasonably possible that the competitor may win the lawsuit. This we're going to footnote. However, again, we would want to accrue the legal fees because that's what's going to kill you and all this stuff. So what is our journal? Based on what we did, we'd say we'd have to accrue $200,000 and the offset would be estimated liability from lawsuit. However, again, on the other two cases, you'd also be accruing the estimated legal fees because, again, it's something you have to consider when dealing with any type of litigation. And that ends part 1.